David Moore with Equity Advantage, 1031exchange.com, here with Robert Smith today of Peregrine Private Capital. And we're going to talk about all things DST. But before we get to that, I think we need to sort of talk about the elephant in the room that people are denying right now, and that's inflation. So I just laugh. I made a comment earlier about a shopping cart getting out of the store without spending a few $100. We all hear the ads and see the ads for tangible assets, gold and silver and palladium and things like that. I like to say real estate, in my opinion, is the ultimate tangible asset, and I say that because I was taught never to bank on appreciation, and with real estate I don't have to bank on appreciation. It's working for me whether it goes up or not. I've got somebody else making the payments for me. I've got interest deductions. I got depreciation. Even my IRA 401k clients can, most of them come to us because they want to buy real estate. They want to diversify outside of Wall Street. And I've been to presentations not given by you in the DST space, but where the sponsors basically saying, well, you can't take an IRA or 401k and put it into a DST. And I'll make the comment, well, yes, certainly you can. And they say, well, why would you do that? Well, just go buy a REIT. And obviously we're talking about apples and oranges here. A REIT's just a stock. You don't get the benefits and burdens of owning real estate, where a Delaware Statutory trust gives you that. But Bob, why don't you sort of give us your perspective on inflation right now, what's going on, and how real estate's going to be a great hedge against it?
David, we've been beating the drum for over a year now that inflation's coming. Mentioned that in our last video, that COVID-19, government shutdown of the economy, and concomitant increase in money supply has created the perfect witch's brew for inflation. Of course, you have a whole generation of central bankers for whom this is simply not part of their life experience. So they have been assuring everyone that it's dead, gone, done, finished, and never going to come back. And then all of a sudden, it's here. And so now that it's here, they're assuring us it's not going to be transitory. It's not anything to worry about. Yada, yada, yada. Unfortunately, the Fed has 100% track record of being wrong in terms of its prognostications with regard to major sea changes in the economy. And so we think going forward, inflation is going to be a serious issue simply because of the amount of money that's been placed in consumers' hands as a result of COVID-19, the incredible debt burden that's been incurred by our government, which can only be inflated out of. And so we're going to see a major shift in terms of asset desirability. Obviously, the recent volatility that we've seen in the stock market and the capital markets, things like Bitcoin going down 30% in a day or two, I think that's indicative of things to come, and why people should be considering real property as a hedge against inflation, particularly what we call habitational assets, meaning that if we do experience a significant inflationary spike, that's going to be very dislocating from an economic standpoint. So we believe you're going to continue to see institutional cash flows move away from things like retail and office to habitational assets like housing, multifamily, senior housing, manufactured housing, self-storage, anything associated with human habitation, hopefully will do well in an inflationary environment. And that's where we've been directing our clients from a DST standpoint. And that's one of the advantages of equity advantages, self-directed IRA programs, is you can invest in real estate. And I really do believe that asset class is going to come to the fore.
So if we look at IRAs, 401ks, I've often said it's about 2% of qualified IRA 401k money is actually in real estate, and the bulk of that's in REITs, obviously, because it's a stock. It's easy to get into. But I just, like I said earlier, I was at a presentation that was being put on, and the sponsor of the event actually point blank said, you can't buy into that DST with an IRA 401k. And it's like, so I guess I want to stress this point. Often people look at DSTs, Delaware Statutory Trust, as a 1031 instrument. And it's not. I mean, anybody can take money out of their pocket and buy a DST. If you want to do it personally with tax money, great. If you want to use it with qualified money, IRA 401k funds, great. I mean,
David, you're exactly right. Depending on how the DST program is underwritten, many DST programs can and will accept qualified money from IRAs and 401k plans. And actually, on average, about 20% of the equity in any given DST program is absorbed by people not in 1031 exchange.
I didn't know that.
Yeah, people.
I thought we just filled it all.
No.
It's
Close.
not my world.
Close. It's your world. It's your world. Close. But, again, in the past, present, maybe future zero interest rate environment, people have cash sitting around at 0.001%, whatever banks currently pay, which is taxable. They look at a multifamily property, a self-storage property, a senior living property, and say, wow, that, I'm just using this theoretically, 6% cash flow is attractive. And, perhaps all of the things being considered, there'll be underlying appreciation in the product. And so those things can be placed in qualified plans depending on how the DST program is underwritten. So you are correct.
So once again, if you look at tangible assets, inflationary hedges, most of the time a tangible asset, you're banking that it's going to go up in value to make you money, right? That's what you're betting. And I just want to caution everybody out there, when you look at precious metals, for example, if you sell stock, you've got a quoted price and you know where you're going to get out of that thing. But so often with these other assets, what the quoted price is and what you get after that load is two totally different things from what I'm seeing with our clients and what they're actually getting on these sales. But you're still betting that it's going to go up, where anytime we're looking at real estate, you've got a variety of things that can impact the value. Inflation being one of them, but you're going to ride the tide. And I guess one other comment, sort of my bone with the whole thing, and you look at the association that manages, or that you've got for DSTs or TICs or any of those, for example. Forever it was the alternative asset world, right? And I always hate that, because I feel like when you look at a DST or a TIC, or you look at anything that Wall Street doesn't sell, for example, it's called an alternative investment, which makes it intrinsically sound a little flimsy to me. And I think typically you're looking at, if you look at real estate, precious metals and all, they're the oldest, most time-tested investments known to man.
You're exactly right, and I think if we're correct with regard to inflation, then those asset types will certainly become topical again. And for the last 10 years, we've had a decade worth of Federal Reserve monetary adventurism, printing money, distributing money, increasing their balance sheet at historically unprecedented levels. And heretofore, it's defied normal economic rules with regard to inflation. But sooner or later, the piper has to be paid. And if indeed that occurs, then there may be major dislocation in capital markets with regard to equity and fixed income securities, and things like precious metals, real estate, other tangible assets may become a much bigger and more important part of people's portfolio. And I might add, an additional plug for real estate is the precious metals markets can and have been manipulated in the past. Matter of fact, I can't remember the specific name of it. One of the large commercial banks is now under investigation for manipulating the price of gold on one of the major indexes. And I think with the very heterogeneous nature of real estate ownership, I think it's much more difficult to manipulate that market from an asset type standpoint than some of the other assets that more directly fall under the control of large financial institutions. So that's also something to consider.
Well, you mentioned something earlier. I think if you look at the topic of the segment is supposed to be inflation, we're talking about tangible assets as hedges against inflation. But I think you just made a comment that's interesting, because if you look at precious metals, typically you're just looking at a a nationwide or global perspective, right? I mean, it's like gold is X dollars an ounce or whatever it might be, right? But you made a comment earlier about DST offerings, and you pick that food group, you pick the type of asset you want, but you also pick the region. So if we're looking at real estate, you could. It's not that you could. You do have regional inflation, right? So when you're picking out what you want from that menu of options with those DST providers, you can actually pick the regions that you want and the type of asset you want in those areas. So you can sort of hedge against inflation regionally, not just by diversification into the asset itself.
No, you're exactly right. For better or for worse, there has been an ongoing migration of people, money, and businesses out of high tax, high regulatory burden blue states into red states. COVID-19, the attendant economic lockdown hugely exacerbated that because blue states tended to be more draconian in terms of their lockdown policies, have remained locked down, and generally discouraged more business activity longer. They basically had the "we're closed for business" sign up longer than red states. So that accelerated that out-migration of people, money, and business to red states. So obviously, whether it's Texas, Arizona, Nevada, Florida, they're all experiencing some pretty significant asset price appreciation in terms of their underlying dirt. And so you certainly can use that as an additional potential hedge against principal loss by locating your investments in specific geographic areas that you hope or think may experience more appreciation rather than less in the future.
Well, I think if you look at our deal flow right now in here, I mean, like you said, it's going from blue to red. I mean, we got so much business going on in Florida, Texas, I mean, the Carolinas. I mean, all these places that are, going to be pro property owner a lot more. But I think it's really important, once again, if you look at inflation, you look at what's happening, I mean, you've got the ability to pick where you want to be, and a lot of times that is geographic. Now, I mean, I grew up in the Bay Area. You grew up in the Bay Area. I moved up here to invest in real estate, and it was a great move for me. But I think so often you get too close to things, right? So after I moved here, Tom and I put the business together in '91, and we've been handling exchanges professionally since then. Our real estate investment stuff's dropped off just because of the time this business took to take care of everything. But if you look at where the opportunity is today, I mean, is that here? And the answer is no. And I'll tell you that I talked to my wife about it, and Sheila, and it's like she's pretty straightforward on stuff. She cut to the chase on it, and it's like, okay, if I talk to her about taking money, and when I was a kid, to go fly here and there all over the country to go shop for property or go to manage an asset, it was all an adventure. And today I don't want to do that. I just don't want to take the time to go do this stuff. And she'll say, well, gee, I don't want to have to go back and deal with this property. So I want to stress that, once again, if you're about diversification, you're concerned about maybe the properties in your region the inflation's hit and it's sort of out of touch, or you just don't see the opportunity here, you do have the ability to really take a nice geographic outlook on things by using the DST without having to go visit those properties, right?
Yeah, it's really the nice thing about DST is you have national companies with national ownership and management footprints that already have boots on the ground with regard to different markets. So if you're in, say, a Seattle or Portland, both of which have been the poster childs for dysfunctional cities over the last year with COVID-19 and the breakdown of civil society in the urban cores, you don't have to travel physically to Florida, to Texas, to Arizona. You can use expertise already there, the people that are already on the ground, that already own and operate properties in those markets. You, as a real estate owner, can leverage up on their expertise and diversify your property portfolio outside of your metropolitan area. We make the point that even though Oregon continues to gain population, I think we gained one congressional seat this year, that's not going to Portland. Most of it's going to outlying cities, communities, because people can now work remotely. And I think personally, cities like Portland, Seattle, to a lesser extent San Francisco, are going to be at some point in the not too distant future experiencing what we call the Detroit syndrome, and with their urban cores being hollowed out, and it's going to take a long, long time for them to come back. And so you as a property owner don't necessarily have to sit there and endure that. You can take your money someplace else and again leverage up on the ownership and management expertise of very large national companies that are already there.
And I think the sponsors have the horsepower to actually deal with the regulations that the individuals don't. And just two examples of that. We had, I have to say, a number of retirement clients, IRA 401k clients that had rental houses in Multnomah County until this last year. And what happened is our politicians decided that and they were using VRBO, vacation rental by owner, as a rental platform for those assets, and they worked very well for those clients. And then the politicians decided that you could not use VRBO on anything unless it was owner-occupied property, which totally eliminated that whole pool of available properties, right? So our clients had to sell their properties and move elsewhere. So you change the nature of things, it gets more complicated, you can't do it. And so you're looking for, where you're going to go geographically that's going to offer you the ability to go and have some return safely without having to necessarily deal with the assets. And I saw just yesterday, I was dealing with another client, and this is elsewhere in the country, and another IRA 401k client that had properties, and now this state has decided that every rental is in and of itself a new business. So they have to get a business license for every rental property. Oh my God. So how do you think that's going to impact rental prices, right? I mean, it's just absolute craziness. But this is the type of stuff we're dealing with over and over again, and that's why we have so many people moving from where we are into these other places. But for those of us that as we get older, I'm more interested in playing these days. You know me, I like to play. Fun's the best thing to have. And so for me to have to go deal with some tenant on things or deal with all this stuff, I really don't want to do it, but I still love real estate, and that DST is the place to go. And once again, I'm going to say real estate is the ultimate tangible asset, the ultimate inflationary hedge. And that's what we're here talking about today. DSTs, it's just a different form of real estate investment. It's a passive investment, but it gives you all the benefits and burdens of real estate ownership, and it's a great place to go. So once again, David Moore, Equity Advantage with Robert Smith of Peregrine Private Capital. Thank you for joining us today. We'll be right back with another segment. Thank you.
Thank you.